everybody. Thanks for joining us today. Today we're joined by Steven Tebbutt and Jonathan Harvey from MHA. Steve's a partner at MHA specialising in entrepreneurial tax and employee ownership. And Jonathan is a senior tax manager specialising in share schemes and incentives. So what we'll do, I'll hand over to Steve and John in a moment to do their presentation, and afterwards we'll have a Q&A session. If you have any questions throughout the meeting, just put them in the chat box and I'll aim to get through those at the end in order. So I'll hand over to John and Stephen, if that's okay. I'll let you carry on.
Brilliant. Thank you, Ben. Welcome everybody. Thanks for joining us for our webinar on share schemes and employee ownership. As Ben's mentioned, my name's Steve Tebbutt. I'm a tax partner at MHA. If we can turn the slide, there's a few statistics. I'll try not to labour the stats too much, but just a bit about MHA. If you don't already know us, we're the UK member firm of Baker Tilly International, which is a globally recognised name. I think it's now number 8 in the world as a firm of accountants, tax, business advisors. Really, what that means for me in practice is that MHA, as the UK member firm, have got sort of global bandwidth. So we've got specialists that deal not only in every tax, we've also got people in each jurisdiction to make sure our clients' affairs are joined up, which is great for us and our clients. But if we can turn the slide again, I won't labour this too much because we want to sort of fix on the subject more than anything. A bit about me and John. As has been said, I'm a tax partner. I've been at the firm since 2007. Ben mentioned that I'm involved in entrepreneurial taxes. That's where I spend a good chunk of my time. Also spend a lot of time in our employment tax team around share schemes and employee ownership, which is kind of the focus for today, but deal with a lot of other things besides that, which sort of fit in nicely around exit planning, succession, restructuring, etc. John, do you want to say a little bit about yourself?
Yeah, sure. Thanks, Steve. So my name's John Harvey. I'm Senior Share Schemes Manager. And since 2017, I've been specialising pretty much purely on share incentives, so helping companies implement share plans, select the right one that works for them, and all of that comes with it. So that's right at the very start all the way through to the very end when they're going through a transaction and beyond that even. So we've got a fair amount of experience in this world.
Brilliant. Thank you, John. On the next slide, we've got a little bit of a summary as to what we're going to go through, which is hopefully sort of a aligning of everyone's expectations. Very happy to take questions at the end if we've not covered anything you've got a particular interest in. If we can't cover it in the time allowed, then obviously happy to follow up after the session. So John's going to kick off primarily in talking around scheme selection and design of equity incentives. There's a number of different plans available, as some of you will already be aware. So there's EMI, which is the Enterprise Management Incentive Plan, the company sharing plan, CSOP. They're the sort of most popular tax advantage plans, as they're known. There's also a lot of other share plans available. We're going to look at some of the key ones there that we see being used primarily, which are growth shares and nil or partly paid share plans. We'll go through in a bit of detail about what those different share plans mean in terms of benefits for employees and the employers, i.e. the business. What they should be thinking about really in terms of choosing schemes and what the outcomes might look like. We'll also share some of our experiences about pitfalls, etc., i.e. challenges we see and how to avoid them, how to make sure you're getting the right outcome and navigating any dangers. I'll then pick up talking a little bit about employee ownership, and particularly employee ownership trusts, which is the most common mechanism for moving to employee ownership these days. I'll say a little bit about how they compare to share schemes and how they can fit together if we get time to go on to that. And then as we said, we'll have some time for Q&A. So that's kind of the boring preamble bit. We'll crack on with the actual meat of the session now, John, if you're right to pick up from there.
Absolutely. So thanks very much, Steve. As he mentioned, I'm going to be looking at share schemes and talking more about that in more detail. So when might you look at implementing a share scheme then? Well, the main times that we see this is the primary driver is that you're trying to tie in your key staff, because they're arguably the most important asset of many businesses. So it's to recruit them in, it's to retain them, and to essentially drive performance in the business and align their interests with that of the shareholders where possible. Now, what type of companies typically use share schemes? So you're normally looking at ones where they're using maybe a startup, cash is tight, and as a means to incentivize people, you want to give them a share option or give them some shares in return for a cash bonus, just to save a bit of cash flow. That's quite key for startups. We see that all the time. Now, also in line with that as well is for startups or high growth companies where you're expecting a good return in value. Obviously, everyone's hoping for that, but you might want to lock in the value of those shares now. So give the shares out to employees whilst their value is still relatively low, so that the maximum amount of growth can be given to them in more tax favored ways. But also companies might be looking to exit in the short to medium term, and they want to make sure that the right people are incentivized to help the company achieve that. But lastly, we see quite a lot of this where lots of transactions going on in the world with private equity. And normally we see that once that transaction goes through, people want to make sure, the PE house typically want to make sure that the management are tied in, and we see management incentive plans rolled out, variety of different ways that you can do that. And we'll talk more about what we can do and when later on in this session. So moving on. I think it's always a good thing to just go back to basics a little bit before we delve into a little bit more detail as to why we look at share schemes in the first place. So the default tax treatment really is all to do with employment-related securities. And that is essentially anti-avoidance tax legislation. And it comes into play where you've got the transfer of value in the form of equity to employees as a reward for their performance or services. So if you're giving them shares, that's going to be the tax point for them. And broadly, it's the market value that they get taxed on, unless they pay something for it or pay something towards it, in which case that reduces the amount they're going to be taxed on. If you're giving them an option, and that's a genuine right to acquire shares at some point in the future, well, the tax point will actually be when they exercise that option. So that's normally when a transaction happens or some point in the future where the growth has been realized. Well, the default treatment is that they will be subject to income tax and potentially national insurance contributions. And that's going to be at a higher rate typically than your capital gains tax. So we then want to try and see, is there a way that we can get capital gains tax treatment on that using one of the tax favored plans that are available out there? There is also other scenarios where you need to worry about employment-related securities legislation. So that's things like disposals of shares for more than they're worth, or artificial transactions which can capture this. So it's always worthwhile bearing in mind how this can bite and reaching out to tax advisors to make sure that you're all covered. Now, our typical approach when we're looking at these things, if you come to us and start talking about we want to do this, well, we always start with the fundamentals of making sure that the right scheme is implemented from day one. So that conversation will revolve around what's the end goal and making sure that the right one is put in place for you. Once you've decided on that type of plan that you want and it works for the company, you might go through an initial feasibility study, for example. You then look at how you can design that to fit your needs. So that will be things like who's going to be included, how's it going to work, is there any vesting, performance criteria, things like that. We'll touch on this in a bit more detail in a moment. But once you've decided how it will look, what you're going to do, it's then moving towards implementation of that plan. And then also after that, there's going to be the reporting requirements that might arise, which that can be dealt with either in-house or you can appoint an advisor to help you out with that, all of which we can help with. So selecting schemes and designing them, what are the types of things you want to be thinking about? Well, like I said, very first thing is, what's your objective? Is that going to be something that you want to tie in particular individuals? Are you gearing towards an exit? what's your ultimate aim for this plan? Is it simply going to be something that you want to give as an annual bonus or annual award so that individuals can realise their value? And all of these things will demand a different plan to be put in place. So that's the very starting point. But also, tax might just not be a driver, in which case you might want to be thinking about something more straightforward than a share plan. But if you do decide on a share plan or share incentive, then a bit more detail about that. Well, who is it going to be? We're going to be focusing more on discretionary plans that is your enterprise management incentive or company share option plan. But if you're looking to do one for everyone, then that's going to potentially dictate another plan that you might want to use, such as a SIP or share incentive plan, that is, or, for example, a save as you earn scheme. That's more typically aimed at your big listed entities where it's quite easy to realise value. But for now, we'll focus on EMI and CSOP. So what? Well, is it going to be an award of shares, or is it going to be the grant of a share option, for example? You're then thinking, okay, if we do give someone shares, do we want to claw them back off them in a certain period of time? Or if they leave, clearly you don't want to, or usually don't want that individual to continue to benefit from those shares. Or indeed, if they've got an option, it's probably clawed back off them. So all of these things need to be borne in mind. When? Well, as I was saying earlier, is it an award of shares now, so they get their hands on it? They can potentially have dividends. Or is it something that you don't want to give away any control, so voting rights, for example, and therefore you might want to give them an option so that it happens on an exit, for example. So all of these things are part of that initial design consultation and talking through with an advisor to make sure you've got the right plan. But then fundamentally as well, what you're giving them, if you're doing, say, a growth share plan, you might need to consider the articles or shareholders agreement to make sure that they can actually be given those shares. And once they're part of that, how are they governed? And is there anything that you need to be mindful of before you award them? So moving on then, just talking about what is available out there. So like we mentioned, EMI and CSOP is the one that we're going to be focusing on. And they're part of the 4 tax favoured plans that are operated in the UK. They come with their tax advantages, hence their tax favoured status. And then we'll also look at, if EMI and CSOP isn't available, what else can you do? Well, that's things like growth shares or partly paid share plans. And I'll go into a bit more detail once we get there. Now, if you're not looking at something that fancy and tax isn't a driver, then you might be looking at something simple. And that could be just a grant of an option or giving them shares. And that's where tax isn't necessarily a driver. But you could also have other arrangements that are imported by, say, a US company. They like their restricted stock units. So it might be a case of just being mindful of, okay, we've been acquired by a US business, for example. They've got RSUs. How are they taxed in the UK? Sometimes we have got international clients that come to us and ask for that guidance. So it's just being mindful that there are those types of arrangements out there. But lastly, the phantom plans, that's where you can do a cash bonus scheme, but that cash bonus is aligned to the performance of the business and the value of the shares. And that's how they realise their cash bonus. It's taxed in the same way, but it's then just structuring a cash bonus to align their interests with that of the shareholders. So that's an option. Diving into EMIs then. So why are they so popular? Fundamentally, it's because they are the go-to plan if they're available, because they are so tax advantaged. And that is because they're a type of share option plan. So they don't get any benefit from the shares until they exercise their option. And that's normally linked to an exit. Why is it so good? Well, as I touched on earlier, normally in the absence of an EMI or tax favoured plan, the tax charge on exercise, so when they actually get their shares, is based on the market value of those shares at that point. If it's on an exit, all of the growth is already realised. Whereas here on an EMI, the way it works is the tax charge on exercise is based on the lower of the market value on that date or the market value on grant. So if you've got a company that's worth very little now, well, essentially, all of the growth in the value of those shares from now to the exit would be subject to capital gains tax. Excuse me. Now, that's provided, of course, that the share option has an exercise price equal to the current market value. And as long as that's the case, then you do normally get all of the growth subject to CGT. There are reduced requirements for business asset disposal relief, which is formerly known as entrepreneurs relief. There is a CT deduction at exercise as well, which can be quite valuable. Excuse me. Now, there is a lot of conditions to be mindful of course, because with something being so tax advantaged, there is normally some conditions to go along with that. And this is normally aimed at your small to medium-sized trading companies. But we did see recently, in April 26, that those limits have been relaxed. So whereas previously you may not have qualified, now is an opportunity to look at this and think, okay, well, if you have had a lot of growth or you're a larger entity, EMI might now be available to you. So it's worthwhile taking a look. So previously, gross assets had to be £30 million, whereas now it's only available to companies with assets less than 120 million, employees numbers of less than 500, whereas previously that was 250. Beyond that, though, the company limits, we've got to have an independent trading company. So what does that mean? So it can't be under the control of another company. So it has to be controlled by individuals, and trading, excuse me, to a substantial extent isn't an investment business. So if you've got a large cash balance, for example, or rental assets, that might need to be looked at a bit more closely. The limits for individuals is currently 250,000, and that's based on the market value of the shares today when they're granted. And then there is an overall limit for the company, which has been doubled from 3 million to 6 million from the 6th of April. But because this is normally aimed at, well, used to be aimed at your smaller companies, it was always a backup option to have a company share option plan. Now, there's a couple of relaxations on company share option plans, and the two key ones there are, for EMIs, you had to be a trading company, whereas for company share option plans, that's not necessarily a condition. You do still need to be independent, though, of course. Excuse me, struggling with a cough, I do apologise. Now, the other conditions as well that's relaxed is that although you have to be an independent company, you can be a company that is under the control of a listed entity. So that can open up the opportunities as well. But also, the size of the company isn't an issue for a company share option plans, but it is somewhat limited when compared to EMIs, because you'll see there that the limit for individuals is not 250,000, it's 60,000 per employee. But similar to EMI, it's tax advantaged, and the income tax isn't due on exercise, but the option does have to be granted with an exercise price equal to the market value on the grant date. So that's quite key. Steve, would you mind if I hand it back to you for a moment?
Yeah, of course. Get yourself a drink, John.
Yeah, I just need to relax my throat for a second.
Yeah, so just to pick up then on growth share. So John's gone through the main tax advantage share plans, as they're known. As you said, you would normally go with those if you can, because of the substantial tax advantages, i.e. ability to get capital gains tax treatment and the corporation tax deductions. Growth shares are also very good in that they can give a lot of the same sort of economic results, in that you can still get the growth in value subject to capital gains tax. The way these would typically work is that you might have people, for example, that you're looking to reward in future. You're looking at the value of the shares that you would ideally give to them, and if they were just vanilla shares in the company, you pro rata the value of the company might be significant, such that if you were to award them to those individuals without anything paid in return, there'd be that significant tax bill for them to pay. So, as John went through before, the basic position is that if you were giving someone shares worth, say, 100K and they didn't pay anything for it, they'll get a 40K tax bill, for example, or if not more. With a growth share plan, that 100K starting point, you can potentially structure the shares so that the value is worth less than that, and that's an affordable level. So the way you might typically do that would be to build in a hurdle into those shares, which says that those shares only essentially vest, become valuable upon meeting certain conditions. So that might be a hurdle in terms of the company's financial performance. So it might be if the company achieves a certain value, that at that point the value of those growth shares kicks in. And the reason why that's attractive is that where there's that hurdle in place, it suppresses the value of the shares on day one. Now, unfortunately, there isn't a kind of a statutory position on this, or a set HMRC guidance on the impact of that hurdle. It used to be that once upon a time there was a sort of broad rule of thumb that if you had a sort of significant hurdle in, the shares might only be worth a small percentage. But HMRC have moved away from sort of any fixed position on this, and now it's very important that there's careful modelling done around that hurdle and the value of the shares. So that probably speaks more to one of the disadvantages, in that there is some complexity, both in terms of setting up a separate class of shares, making sure the hurdle is at the right position. The more complex valuation model essentially means that there's more professional fees. So frankly, setting up a growth share plan is typically more expensive in terms of tax and solicitor fees, in terms of setting up to make sure you're getting it right. The upside, though, is that you're still able to give employee shares with a low buy-in and a significant potential upside, where that growth in value, so where the hurdle is unlocked and there's the step up in value, if they realise their shares, that growth difference between what they've paid and what they realise is subject to capital gains tax rates, which is no more typically than 24%, as compared to that sort of 40% plus income tax rate that I mentioned before. John, are you around to turn the slide? Did you want to pick up again, or do you want me to keep going?
Yeah, very happy to pick up again. Sorry, I needed to clear my throat. I do apologise. But I'll turn this over to the next slide. Thanks for that, Steve. So part paid share plans. So these are really useful if you've got a company or a business that's already established quite a lot of value. So it's an established trading business. The shares are of a substantial value where that might be a barrier for individuals to be awarded shares. Now, it is possible to do a hybrid plan where it's growth shares, so you reduce the value of those shares, but they can still be deferred. What this essentially means, doing a partly paid share plan, is to avoid the income tax charge on the market value of those shares on entry. You essentially agree with the employee that they would pay the current market value for those shares. And because they are agreeing to pay that, there's no income tax or national insurance due. But they don't actually pay that subscription price until a later date. Now, normally that later date is set out in the subscription agreement that they enter into. And it's normally when they leave the business, if that happens before an exit, or when they ultimately dispose of their shares on an exit event. Now, as I say, provided the subscription price is equal to or more than market value, and that's the tax market value, then there's no income tax or NIC on entry, and all of the growth in the value of those shares is subject to capital gains tax later. Clearly, that's better than your usual income tax rates. But the big disadvantage and the thing that the participants would need to be mindful of is that, as with any acquisition of shares, even on the open market, there is that risk that the value of those shares could go down. And because they are on the hook for that subscription price, it does have to be paid at some point. So they might realize a loss. Worst case scenario, company goes into administration. Those administrators will be seeking that subscription price that is due. So that's something to be careful of. Now, normally it is possible to structure this in a way that if you have a lever, that would be dealt with by buying the shares back off them when they leave, and we'll touch more on that in a second. The other things to be mindful of is that because it's a loan for tax purposes, that will potentially give rise to a benefit in kind if the value is more than 10,000. But there are reliefs available that we can look at if you were to go down that road. For example, if they're director level and they are steering the direction of the business, that might be a way that they would not have a benefit in kind on those shares. The other disadvantage is that you can't agree a value with HMRC, but normally you would have an independent third-party valuation carried out to support the value when starting out on this. And that's important because if you do have an exit and you've got part-paid shareholders, the due diligence team coming in on behalf of the buyer would almost certainly want to see a valuation of the shares, just to make sure that there was no historic liabilities or indeed a liability arising on exit. You do have to amend the articles to make sure that you can award shares on a partly paid basis. So that just steers into the complexity of what you're doing from the day one. And that can sometimes include additional legal costs to draft those. So that's something to be mindful of. But a very good plan, and is quite commonly geared with a growth share plan to limit that capital risk and make it so that it's not a barrier for entry for the participants. So what are the common challenges that we see when implementing share plans, or indeed having a company come to us and wanting to realise the share options or share awards that have been granted to their employees? Well, stepping back a second, it's even right from the get-go. Sometimes we have had businesses where they've had a share plan in place and some of the employees just didn't know what it was that they were offered. And clearly, if that is the case, well, if you're implementing an incentive and the participants that you're awarding it to don't know what they're receiving, it's not going to do much in the way of what you want to achieve from it in terms of driving their performance and tying them in. It's got to be something that they're fully understanding, and so that it aligns their interest with that of managements and shareholders. So we do try and say right from the get-go, if we were helping you put in a plan, that employee comms is part of the considerations, and we can help with Q&As or FAQ documents, and we regularly help our clients put those in place so that the participants are fully aligned and fully informed as to what they've got. The other common challenge that we see, lack of liquidity. So with private companies, clearly it's quite difficult to realise the value of those shares because there's no market for them. So what do you do in the scenario that either you've got someone that's got some shares and they're leaving the business, you want them to have value for that? Well, normally the only way that you can realise that value is arrange a sale between the shareholders, or you have an internal market where you're matching buyers with sellers, and you can do that on a regular basis. That does help achieve capital gains tax potentially on those scenarios, but normally you do have to have these plans. We see it normally that they're linked to an exit event, and the third-party buyer coming in acquires all of the shares. There are ways around this, and it's not necessarily an issue, but it might just mean that you have to think about annual matching, or potentially the use of an employee ownership trust or some form of employee share ownership trust that can then manage these internal markets. But the other part of this is valuation. So clearly you do want a valuation whenever you're looking at share plans or share incentives. One, to prevent challenge from future buyers, due diligence team, but also to make sure that you're fully covering off the tax implications that are arising. But if you have an internal market, then normally what we see is that the valuation methodology on the way in is the same as the way out. And you may see or have heard that when you're looking at small minority interests that are awarded to employees, that there's normally a discount for lack of marketability and control. And you normally see, if it's less than 5%, probably about 75%, or between 60 and 80% discount. But on exit, because 100% of the business is being acquired, that discount falls away, which is good. But then on the flip side, if you're looking at realizing an individual employee's value before an exit, in the absence of any market, then the tax market value of what they've got would be standing at a discount to the pro rata value of the whole company. That can sometimes present challenges because the articles will say that if there's a disposal of shares to the company, that can sometimes take place at what's called fair value. And that then creates a disparity between what they receive in terms of proceeds for their shares and the tax market value, which can, in some circumstances, lead to an employment tax liability, essentially treating the difference between the market value of those shares and what they receive as a cash bonus subject to PAYE, income tax, and national insurance. So putting it through the payroll. And it's about managing these liabilities and negotiating that, or potentially coming up with a different plan if that is potentially an issue. As I touched on earlier, a big challenge and sometimes an issue that we need to come across is for partly paid share plans and where you have leavers. Now, normally, if the value of the business does continue to grow as everyone would want and hopefully expects, then managing leavers isn't necessarily too much of an issue, on the basis that the subscription price that they've agreed to pay for those shares can be taken off the sale proceeds that they receive when they do leave. But unless that's all been thought about on day one when you're implementing the plan, sometimes that can have issues when they do leave. If, for example, they're receiving full value for the shares, then you've got to manage that employment tax charge that I talked about a second ago. Or there's other issues which mean that they would be getting rid of their shares and not receiving anything for it, and they would then be out of pocket for the subscription price that they've agreed to pay. So all of these things need to be considered from day one so that they can be managed in the future when you do have leavers. And lastly there, fundamentally, if you're appointing an advisor to help you with these plans, there will be a cost associated with them, both for tax advice, the legals, and potentially the valuation. And what we've seen, and hopefully this goes without saying, but normally the simple plans are the ones that will be cheaper compared to your more complicated ones. So right from the start, we would always be saying, well, simplicity is favourable over complications, not least from a cost perspective, but also so that it's easier for the employees to understand what it is that they're getting, helps manage the conversations a lot easier, and everyone's looking forward to having a piece of the pie on a future sale. So we would always say simple is best, but ultimately it does depend on what you're looking to achieve. And this conversation is always part and parcel of the first initial design and implementation stages. So it's something to be mindful of. And on that note, I'm going to hand back over to Steve. Thanks very much for covering off the growth shares for me whilst I had a little tickle in my throat. Over to you, Steve.
No problem at all. Thanks, John. So yeah, John and I debated a little bit before about to what extent and to how much we should talk about employee ownership. But the reason for that is that it's something that John and I deal with regularly, as well as the equity plans that John's primarily gone through. But it is a little bit different. So what I mean by that is that an EOT is quite a different outcome in that it's not about delivering shares to employees directly. I'll come on to that. So what we've got up in there's just a quick overview of what I'll go through in say 15 minutes or so. Maybe a bit less actually, to allow some time for Q&A. So I'll cover off briefly what is an EOT. So why would we consider selling to one? What are the pros, cons, and the key issues? And if time allows, how EOTs and share incentive plans can sit together or compare to one another. So why consider selling to an EOT? Well, unlike with a share plan, this isn't, as I've alluded to before, it's not quite the same thing. This isn't about how do you put equity into the hands of particular employees. There's a bit of confusion around that. Sometimes people are talking to me about, oh, should we do an EOT, thinking that that's what it's about, because the concept of an EOT is that you're making all of your employees stakeholders. That is true if you think like the John Lewis model, for example. It's not actually an EOT, but it is a sort of a famous employee ownership business where the principle is that all employees have a stake, everyone receives dividends, etc. That's the model, that's the idea behind an EOT. But the way that it works is that you're fundamentally, if you're an owner in a business, you would be selling your shares in that company to a trust that's been set up for the benefit of all employees. So that the legal owner is that trust. It is holding those shares for the benefit of all employees as a class. It's not a case that John has 20% of the shares, Jill has 10% of the shares, and so on. If there's 100 employees on day one, they're potential beneficiaries of the trust. But it could be that your current crop of employees come and go, and that if it comes to the point of the employee ownership trust ever realizing the value of the shares it now holds, or paying out bonuses, etc., it could be going to different people to the ones that are in place today. So it's not of itself giving equity directly to employees. So why do people think about doing this route then? Well, they've obviously got as you'll probably all be aware, you've got the choice as an owner if you're looking at an exit of perhaps selling to a third party, or you might be thinking about a management buyout. Again, there's a bit of confusion around MBOs and EOTs. There's some similarities, but also great differences in what it achieves. If those routes aren't the right ones for whatever reason, then I think an employee ownership trust is a great option as well. Perhaps you might not have a management team that are willing to take on the risk of taking shares or taking funding to buy shares from the existing owners. Perhaps the owner's reluctant to sell their business to a faceless US investor, for example, who then perhaps looks to sort of trim down the numbers of employees, or might look to flip on the business a few years later, and the effects of that can be huge on employees and sort of small communities, etc. for some businesses. So with an EOT, what you've got is the option for the owner or owners to preserve their legacy by passing their shares into a trust for the benefit of employees. Lets the culture be retained. Helps to promote the long-term future of the business. There's been lots of statistics that show that employee ownership generally means better engagement with employees, better turnover, better profits, etc., better retention of employees. So it's a great way to sell for an owner to sell and realize their investment, but there's also all those soft benefits that I've briefly touched on. Historically, there was some significant tax benefits to selling to an EOT for the vendor. There's still some great tax benefits, but they have been reined in a little bit as HMRC saw that they were being abused, frankly, in some cases, and also that it wasn't really sustainable to have such an advantage in place. The position now, anyway, is that if you were to sell to an employee ownership trust today, you've got an effective tax rate of 12% for the vendors. That's as compared to the highest rate of capital gains tax, which is 24% at the moment. You might get a bit less than that with the benefit of business asset disposal relief, the old entrepreneurs relief. But that business asset disposal relief is now only worth £60,000 because it's an 18% rate on up to £1 million of lifetime gains. if you're selling to an EOT, you've got an uncapped amount of proceeds that you can receive, an uncapped amount of gain that you can realize at 12%. So can be a much more generous tax rate than anything else that's available. It's also got in terms of financial benefits, the upside for the employees themselves from day one is that provided the business can sustain it and afford it, they can receive income tax-free bonuses each year up to £3,600 per year. The trust has to be, as I've mentioned before, for the benefit of all employees. So those bonuses need to be paid out on equal terms. Essentially, there's a little bit of flexibility around things like length of service and remuneration and hours worked, but you can't be pushing bonuses to particular employees as a theory. You can't, you can, I should say, still pay sort of business as usual bonuses to people, discretionary bonuses, etc., at whatever amount you want to, provided it's right for the business. But that the real tax perk is that you can pay £3,600 a year, which is a really meaningful amount for a lot of businesses, of course. Some of the fundamentals of EOTs that I'll just quickly mention, thank you for flicking back, is that you've got to sell a controlling stake to the EOT. So this isn't a case of a sort of a partial realization for the owner. They need to give over control, and that can be a real sort of mental barrier for a lot of founders, is that they need to understand that whilst this is a friendly sale in many respects, that they establish the trust and can largely tailor the terms of their exit, they do need to give up a controlling stakeholding. So the EOT has got to have at least 51% of the shares in the company and the voting rights, etc., etc. That means that as a shareholder, the former owners can't be making those key decisions that they might once have done. They can still be involved operationally as a director in the trading company, but they no longer have shareholder control. So key decisions like if they sell the company, for example, that would be a decision for the trustees, which I'll come on to in a minute. Thank you. If we can flip back the slides to the next one. I'll put up a slide in a moment that shows the structure, which will hopefully give a bit more clarity, because I've rattled through the structure at pace there. But just to briefly to tie in what I've said before about CGT, capital gains tax benefits, and to give some flesh to some of the conditions, as you'd expect, with a great tax rate, there's a couple of hoops to jump through. So some conditions to meet here, which I'll just go over at a high level. The trading requirement is that the company being sold to the EOT has got to be substantially a trading company. So if, for example, there's significant cash or other investment assets like property on the balance sheet, that can be an obstacle to qualification, although there's usually ways to work around that, perhaps with restructuring, time, etc. The all-employee benefit requirement I sort of loosely touched on before. This is the requirement that the trust has to be for the benefit of all employees, so you can't be excluding certain people. There's some limited flex there, so people that have been there for less than 12 months, for example, can potentially be excluded. The controlling interest requirement, that's the 51% test I've already mentioned. The limited participation requirement, this is the requirement that the shareholders and those related to them can't comprise more than 40% of the workforce. That can be one to watch out for, particularly on smaller businesses, sort of more sort of family owned and run businesses. That can be a hazard. Again, there can be ways to deal with that with time and planning potentially, but something to watch out for if you're looking at this. The trustee residence requirement, I won't talk about this too much. There used to be the ability to set up the trust overseas. That was often done for tax planning purposes. That they were closed down by HMRC. So now the trustees, which I'll come on to, need to be UK resident. Trustee independence requirements. So this is an important one, which is that, and it goes back to what I said before about the owners having to accept they give up control. What we used to see back when EOTs first came in back in 2014 was that sometimes the vendors would sell to the EOT, to the trust, and then they themselves would be trustee of that trust. So essentially they still have the keys to the kingdom, have control over the company via the trust. That's been closed down. It's now the case that they can only be in the minority of the trustees or the trustee directors in the top entity. So normally what you would see is you would have an independent trustee, for example, an employee trustee from within the trading group, as well as the founder, the vendor might be on there as well. As long as they're in the minority, then that in principle works. The consideration requirement, I won't go on. I don't think we need to look at that one in too much detail. I might come back to that if we can turn the slide. So I said that I'd give a bit more color on the structure, which I think is important here, because there's a lot of confusion with EOTs around terminology. So I think this does generally help, I find, when talking to businesses about what an EOT means. It's quite a busy slide, so I'll just briefly go through that. So you've got the trade co in the middle there, that is able to pay tax efficient bonuses to the employees, as I mentioned before. The key point that I've not talked about is funding. So what that's showing is how contributions would go from the trading company to the EOT. It's the EOT that's the buyer in this situation of a sale to an EOT, and that owes the vendors money. So funds would go from Tradeco to EOT, who then use that to pay off the selling shareholder. So there isn't typically third-party funding done on an EOT. It's possible, and it's growing in popularity. But another point that vendors need to be aware of is that it's essentially vendor financed, i.e. it's coming from profits within the business. That normally means that there's an element of day one cash that's paid out, as indicated there. And also, if there's not sufficient cash on the balance sheet on day one, as is typically the case, pay the balance off over a period of time. Sort of maybe 5 to 10 years is sort of a common range. Does of course vary depending on available cash and business profitability. That's going to the selling shareholder. As I've talked about before, you've got to have 51% held by the EOT. You can have the vendors that could retain a percentage as long as it's a non-controlling shareholding, and you can still have key management in place as shareholders if you wanted them to. If you were selling, for example, 100% to an EOT, means you've got 49% headroom to provide equity to other employees, management, etc. if you wanted to. The consideration that I skipped over before, this is around the need to ensure that the trust is paying no more than market value. Again, this is something that's been tightened in recent years. Trusts were being set up, aggressive valuations were being put in place such that vendors were able to take out significant amounts at a very generous tax rate, 0% as it once was. That's been closed down, so there's now requirements on the trustees to take reasonable care to ensure that they're paying no more than market value, which I think is a sensible change that's been put in place. Turn the slide. I'm conscious of time, so I'm sorry I'm going through this at pace. So yeah, pros and cons. I think I've essentially covered a lot of this anyway. As I've said, the use of an EOT attractive because it encourages more continuity, so you get to retain the ethos, get more likelihood of reinvestment in the business. It's a friendly sale, so it doesn't mean sort of heavy due diligence as you would normally see on a sale to a third party. There's still an element of it that the trustees would need to do, but far less onerous typically. That less invasive approach means less costs, so generally it's far more cost efficient to set up an EOT than it is to do a trade sale. Of course, there's still complexity potentially that can impact on cost depending on each business. Mentioned before about the tax-free bonuses, and yeah, I've sort of loosely alluded before to the fact that you can combine this with other equity plans as well. So you do still have the capacity to reward employees in all the same ways you already do. And that includes equity, provided you're mindful of that 51% controlling interest requirement at all times. That shouldn't be breached. Otherwise, the tax bill that was saved originally can come back into play. Negatives, well, as I love EOTs, I kind of argue with some of these myself, but there's this potential for negative employee perception. I rarely see that in practice because most employees see that this is more upside than anything. There is a risk, though, that employees will see that there's this debt that's owed to the vendors and might see that there's quite a period of time before they can potentially stand to benefit. The way you would normally help to deal with that is to make sure that there's those employee bonuses being paid from day one, if at all possible. So that would normally get factored into the initial sort of cash flow and valuation exercise. That normally makes it real for employees quite quickly if they can get an early tax-free bonus. Make sure they're communicated to well around the whole piece to get their engagement, etc. That really helps benefit them and ultimately the business. Careful legal and tax structuring is mentioned there. That speaks to cost, but again, it's lower than it can be on other options. Yeah, you can have conflicts that arise between trustees and founder directors. Sometimes you have people trying to wear too many hats at once. Difficulties in having the founder step away fully. The trustees need to be very mindful that they're essentially the guardians of the trust. That's for the benefit of all employees. So they need to be very mindful of their fiduciary duties in that regard. And separating other roles that they might have when making decisions in that capacity. Potential for selling shareholders to not receive their consideration. I've not really talked about that, so very briefly talked about how to defer. There's often an element of deferred consideration paid over a period of say 5 to 10 years. Obviously, there's the risk that if there's not a good management team in place, and if the founder doesn't necessarily stay as involved, then if profitability goes south, then they are at risk of not actually receiving that deferred consideration. That's the jeopardy compared to a third party sale, where typically there's a guarantee of a significant upfront payout. There's also the risks around if tax rules are breached. That, as I say, the tax bill can be revisited, and that's a up to 5-year tail on the vendors. So typically we're seeing more vendors staying involved for a little bit longer than they used to do, and some of those time limits were shorter. But very much depends on case by case. Lastly, a future sale of the company by the EOT might not be terribly tax efficient. There's an element of double tax if that was to happen. That's relatively rare, and conscious of time, I'll move on from that. We could go to the next slide. Just to conclude, I think John covered this to an extent. So whether it's a share plan or an EOT, indeed, if you're thinking about what's the right way to go on that in general, then we can do a feasibility assessment to look at your different options. Then we would get into designing whether it's the share plan or the exit mechanism, EOT, MBO, etc. But ultimately then help with implementation, which is things like the clearance application to HMRC, employee comms, working with solicitors, reviewing their documents, etc., and then actually doing the necessary compliance around making claims for tax relief, etc., reporting shares that are awarded and so forth, and an ongoing compliance with HMRC. These are all things that MHA, John and I and the team are working on regularly. So very happy to help. Sorry, it's a very whistle-stop tour of EOTs from me, despite me talking at pace and for 10, 15 minutes. Hopefully that gives a flavour.
Thanks, Steve. Thanks, John. So yeah, I've got a couple of questions in the box, which we'll get to if that's okay. So going back to the EMI schemes, question here from Phil is: if an EMI scheme has a time-related exercise event, i.e., 5 years from grant, and there's no exit event at that point, is the difference between the exercise price and the market value at the point of exercise subject to income tax for the option holder?
So I'll take that one. So it depends on how the exercise price was structured from day one. So provided you did a valuation when you were originally granting the share options, the EMI share options, and that valuation showed that the market value at that time was, say, £1 a share. If the exercise price was £1 a share as well, then on exercise, they would then ask for their shares to be issued to them. They'd pay over the exercise price, no income tax and national insurance contributions to pay. So nothing in that scenario. But if they were awarded the option, say again with a £1 market value, but an exercise price of, say, a penny, then that 99p per share would be subject to an income tax charge. Might not be subject to NIC, but there would certainly be income tax payable because it's based on the lower of market value on the exercise date, market value on the grant date.
Lovely, thank you. A following question on that. So if an employee has exercised an option under an EMI and no exit event occurs, can they sell their shares? And if they did, what would the personal tax treatment be?
So that would entirely depend on what the articles would allow and what the shareholders would allow. They could potentially sell to the other shareholders if they were willing, and that might be subject to capital gains tax. Alternatively, you would look at a company purchase of own shares, say if they were leaving, but then you need to consider, well, okay, as it's a company buyback, the default treatment there is normally a dividend. So it's subject to tax as a distribution in a normal way.
Lovely, thank you. Any thoughts on awarding share options in a UK company to a US-based employee? That's from Paul.
So that would need to involve both ourselves and the US, for example. You would want to make sure that from a UK tax standpoint, as they're US resident, there's nothing to usually worry about in the UK. So you would need to focus on what the implications would be for that individual in the US. And so they'd need a US advisor. From a company perspective, what you normally see is that the deduction is given to the employing company if there is a deduction available. From a reporting standpoint, if they're US resident and always stay US resident, normally there isn't any reporting for the UK company. But if there's a US subsidiary, there might be some withholding obligations to worry about when they realise their share options or value.
Thank you. Another question here. When is CGT payable on the sale of an EOT? If there is not enough cash on day one paid to the owner, then how do they pay this?
Yes, it's a good question. So the capital gains tax is payable by 31st of January following the tax year of the disposal. So if for example, you sold December last year to make up a date, then tax year ends 5th of April. So your CGT bill will be payable 31st of Jan 27. Because of the fact that typically, as I mentioned, you're paying off the EOT would pay off the vendor, I should say, over a period of time. It's conceivable that the tax bill payable 31st of Jan, you might not actually received that cash by that point, or all of it anyway. In which case it is possible to apply to HMRC to pay by instalments. That's largely untested with the revenue at the moment because this legislation is new and the tax year has just ended. But the principle is that HMRC should be willing to agree that, and the way it would work is that you would normally pay if you at each instalment that you receive from the EOT, the revenue would expect 50% of that to go towards the tax bill. But that is an evolving area because it is so new.
Well, that's all the questions I think relevant at the moment. So thank you, John. Thank you, Steve. Really appreciate your time on that, and thank you everybody for joining us. Copies of this will be available if anybody wants them. I'll send out an email confirming everything afterwards. But thanks everybody, and we'll see you again. Look forward to seeing you again next time.